Chapter 11, Statement of Cash Flows. In this video, we'll discuss how to classify cash transactions as operating, investing, or financing activities. Operating activities. This is the first section of the statement of cash flows. Operating activities include cash receipts and cash payments for transactions involving revenues and expense activities during the period. In other words, operating activities include the cash effects of the same activities reported on the income statement to calculate net income. Common examples of operating activities include the collection of cash from customers or the payment of cash for inventories, and we'll look at more examples in a moment. Investing activities include transactions involving the purchase and sale of long-term assets and current investments. Lastly, financing activities. Financing activities include transactions with lenders, such as borrowing money and repaying the debt, and with stockholders, such as issuing stock, paying dividends, and purchasing treasury stock. The total net cash flows from operating, investing, and financing activities equal the increase or decrease in total cash for the year. So the balance at the beginning of the year plus or minus net cash flows as reported on the statement of cash flows equals the ending balance of cash reported on the balance sheet. And we'll take a look at that with the format of the statement of cash flows. This is eGames Inc. This is the company we'll be following in this chapter. As you see, we start out with the statement of cash flows. We have the three-line header, name of the company, name of the statement, and it's for a period of time. It's for the year ended. The basic format of all statement of cash flows follows this layout. The first section is the cash flows from operating activities. Then we have cash flows from investing, cash flows from financing. Don't get caught up in the details. We're going to go over these one by one. But you see, we start out with net income under the operating activities section. We make adjustments, and we arrive at cash flows from operating activities in this right column. Then we have cash flows from investing activities. Don't get caught up in these details. We'll look at those in another video. But the total net cash flows from investing activities is a negative $29,000. Make sure you have the parentheses because it is negative. Cash flows from financing. Again, we'll look at these in depth, but you'll see when you add these two together, we again have a negative cash flow from financing of $7,000. When we add the three together, we get a net increase in cash of $14,000. It could be a decrease, but in this instance, it's an increase. The cash balance at the beginning of the period from the balance sheet is $48,000. $14,000 plus the $48,000 equals our $62,000 cash balance on the balance sheet at the end of the period. This is a check figure. This has to work. You have to be able to take beginning plus your net increase or decrease in cash and get the ending cash. If you don't get this, you've done something wrong up here and you've got to go back and rework it. Also, there's a note here for non-cash activities, and we'll discuss that later also. But that is a note of a significant activity that has occurred where cash was not directly involved. So this illustration is a great illustration. I highly encourage you to review it, print it out, bookmark it, whatever you need to do, because this is going to be important. Cash flows from operating activities. Examples of cash inflows, cash coming into the company, is the sale of goods or services and the collection of interest and dividends. Cash inflows from investing activities include sale of any investments that you have in other companies, sale of your long-term assets, and any collection of a note receivable, which is also a long-term asset. So we're looking at the long-term assets here, our property, plant, equipment, and then our notes receivable. Cash inflows from financing activities would be if a company issued bonds payable or notes payable and issued stock. In all of these, you would be debiting cash, so your cash is an inflow. Cash outflows from operating activities. Common ones include the purchase of inventory, the payment of operating expenses like rent, salaries, insurance, payment of interest, and payment of income taxes. Notice that the payment of interest is included in the operating section and not in the investing section. Cash outflows, purchase of investments in another company, purchase of a long-term asset, property, plant, equipment, land, and lending notes with notes receivable. These are cash going out. Your cash outflows from financing activities, repayment of bonds or notes payable, acquisition of treasury stock, and payment of dividends. These are you would all be crediting cash for all of these activities. Notice, if you collect interest or dividends, it's a cash inflow under operating. If you're paying dividends to stockholders, it is a cash outflow in the financing section. When preparing the statement of cash flow, we have to review some different information sources. The first place you want to look is the income statement. We'll look at the income statement to evaluate revenues and expenses for information in determining cash flows from operating activities. The second place we'll look is the balance sheet. We'll analyze changes in assets, liabilities, and stockholders' equity from the end of the prior period to the end of this period to help identify cash flows from operating, investing, and financing activities. We're looking at the changes in these accounts. Lastly, detailed accounting records. Sometimes we need to review the accounting records for additional information to determine specific cash inflows or cash outflows for the period. And we'll look at some examples of what you would find as detailed accounting records. So this is a great illustration to demonstrate the relationship of the income statement and balance sheet to that statement of cash flows. Everything that is blue is considered an operating activity. Your revenues, your expenses, changes in current assets, and changes in current liabilities. All of those will be reflected in your operating activities section. The red, changes in long-term assets, are investing activities. The changes in long-term liabilities, any changes in common stock, and changes in retained earnings, which is where your dividends you pay would show up, are financing in the green. When you add the changes in these three, the net cash flows from these three, you get your change in cash. So, non-cash activities. What if a company borrows $200,000 in cash from the bank, issuing a long-term note payable for that amount? They would record that transaction in the statement of cash flows as a financing activity. It's a long-term liability, so it's a financing activity. Then, if the company took that cash and bought new equipment, the company would report a second transaction as an investing activity, the purchase of the long-term asset. But what if, instead of two separate transactions, the company acquired $200,000 of new equipment by issuing a $200,000 long-term note payable to the seller? This single transaction does not affect cash. You will be debiting equipment and crediting a note payable. So there's no investing or financing activities to report. You then would have what's considered a significant non-cash activity. It will be a significant change in your long-term notes payable liabilities and in your long-term assets, but it didn't affect cash. So these are reported as a note in the financial statements or after the statement of cash flows. Like I said, examples of significant long-term, significant non-cash investing and financing activities. Purchase of long-term assets by issuing debt. That's the example that I gave you just a minute ago. Purchase of long-term assets by issuing stock. You buy a piece of equipment from someone and give them stock in exchange. You would be debiting your long-term asset and crediting your stock. No cash involved. Conversion of bonds payable to common stock. You would be paying off the bond payable by issuing common stock. So your debit would have been to bonds payable and your credit would have been to common stock. We've had significant changes in those activities, but no cash was involved. Exchange of long-term assets. You exchange one truck for another truck. There might be a big change in your long-term asset account, but no cash was actually involved.